On the 20th of April, 2020, something happened that was supposed to be impossible. The price of a barrel of American oil fell to minus $37. Not cheap. Negative. Sellers were paying buyers to take it away. The most important commodity on Earth, the black liquid that moves every ship, plane and truck on the planet, was briefly worth less than nothing. And here's the strange part. Less than 2 years later, that same barrel was selling for over $130, from minus 37 to plus 130 in 22 months. How does anything swing that violently? For most people, the oil price looks like pure chaos, a scribble driven by wars, embargoes, and headlines nobody can predict. But when you pull the camera all the way back, not months, not years, but 160 years, something surprising appears in the noise. A rhythm, a heartbeat. The oil price, it turns out, is not random. But it isn't a clock either. And the reason why is one of the most elegant and most expensive lessons in economics. To hear the rhythm, you have to know the story in 3 acts. First, the frontier, when nobody was in control, and the price went wild. Second, the long calm, when a handful of men in Texas quietly flattened it for 70 years. And third, our own age, when control passed overseas, and the swings came roaring back. Same commodity. 3 completely different heartbeats. Let's start at the beginning, in a Pennsylvania valley in 1859. In 1859, a man named Edwin Drake drilled the world's first commercial oil well near Titusville, Pennsylvania. Within a year, the valley was a forest of wooden derricks, and immediately the industry discovered the curse that would haunt it forever. When everyone drills at once, the price collapses. Early oilmen had no idea how much was underground or how to pace it. They pumped as fast as they could and drowned their own market. Prices whipsawed from a few dollars to fractions of a cent and back, sometimes within a single year. Then came the American Civil War, and in 1864, the real price of oil hit a peak it has never touched again in inflation-adjusted terms. Higher than 1980, higher than 2008, and just as fast, it crashed by around 85%. This was the frontier at its wildest. Booms and busts every few years, fortunes made and destroyed on a rumor. It was so destructive that one man set out to end it. John D. Rockefeller didn't control the wells. He controlled the refineries, the choke point every barrel had to pass through. Through Standard Oil, he began imposing the first real order on the chaos. On a hill in Texas, in 1901, a well called Spindletop blew a geyser of oil over 100 feet into the air, 100,000 barrels a day from a single hole. The center of gravity of the oil world shifted to Texas, and 30 years later, in 1930, prospectors found the vast East Texas field, right as the Great Depression hit. The result was a catastrophic glut. Crude crashed from $1.19 a barrel to 65 cents and kept falling. Wells were pumping oil worth less than the barrels it sat in. Texas was staring at the same curse that ruined Pennsylvania. But this time, the response changed history. A little-known agency called the Texas Railroad Commission was handed an extraordinary power. It could tell every oil producer in Texas how much they were allowed to pump. They called it prorationing. By throttling supply to match demand, they did something no one had managed before. They made the oil price boring. For the better part of 40 years, real oil prices drifted gently downward and stayed remarkably flat. Alongside the great Western oil majors, the so-called Seven Sisters, a small commission in Texas effectively set the price of oil for the entire free world. There were tremors, of course. When Egypt seized the Suez Canal in 1956 and tankers had to sail the long way round Africa, prices twitched. But every time, the system absorbed the shock and settled back down. The wild frontier had been tamed into a quiet, managed calm, and a whole generation grew up believing that cheap, stable oil was simply the natural order of things. But control is a thing you can lose. As American demand outgrew American supply, the power to move the price slipped away from Texas and crossed the ocean to a group of oil-producing nations who had been watching and organizing. Their name was OPEC. In October 1973, in response to a war in the Middle East, the Arab members of OPEC cut production and declared an embargo. In months, the price tripled. Petrol stations ran dry. The West learned that its entire way of life was hostage to a valve it did not control. The 70-year calm was over. The heartbeat was back. And this time, it was violent. In 1979, revolution in Iran sent the price into its second shock, and in 1980, it reached the highest point of the modern era. Every forecaster agreed oil would only climb higher, forever. They were catastrophically wrong. High prices had quietly done two things. They made the world use less oil, and they made expensive new oil fields worth drilling, from the North Sea to Alaska. Supply swelled. Demand shrank. And in 1986, Saudi Arabia, tired of cutting its own production while everyone else cheated, opened the taps. The price didn't drift down, it collapsed, falling by nearly half in a single year, below $10 a barrel. The lesson forecasters refused to learn. Nothing cures high prices like high prices. By 1998, after another glut, real oil was as cheap as it had been since before the First World War. One famous magazine cover wondered aloud if the world was drowning in oil at $5 a barrel. And here you have to notice a pattern in the forecasts themselves. At every low, the experts declare oil will stay cheap forever. At every high, they warn the world is running out. Both are wrong, every single time. On cue, in 1998, the rhythm turned again. This time, the engine was China, an economy industrializing faster than any in human history, swallowing oil, steel, and concrete at a pace the world hadn't planned for. Through the 2000s, the price climbed, and the old fear of running dry, of so-called peak oil, came roaring back into fashion. In 2008, it spiked to nearly $150 a barrel, and analysts sketched 200, even 300. Then the financial crisis knocked it flat within months. What came next was the highest sustained real oil price in all of history. 3 years, from 2011 to 2014, parked above $100. And those prices set a trap, exactly as they always do. $100 oil made a difficult American technology suddenly profitable: shale. Fracking turned the United States, in a few short years, into the largest oil producer on Earth. Supply exploded. In 2014, OPEC chose not to cut, betting it could crush the newcomers by flooding the market. The price fell 75%. The newcomers bled, but most of them survived. Once again, the cure for high prices had been high prices, which brings us back to where we began. In early 2020, a virus shut down the planet. Overnight, the world simply stopped burning oil, but the wells couldn't stop pumping, and the tanks filled to the brim. With nowhere left to put it, the price of a barrel fell straight through zero to minus $37. And then the pendulum did what it always does. Years of underinvestment met a rebounding world. In 2022, Russia invaded Ukraine, and oil rocketed back over 130, from worthless to priceless, in 22 months. So is it just chaos? Now we can finally answer that, because every one of these swings shares a single hidden mechanism. Here is the engine underneath all of it. Oil is not like other products. When the price of coffee rises, farmers plant a little more and get a bigger crop next year. Supply answers demand quickly, so the price settles. But when the price of oil rises, a new oil field takes 5 to 10 years to find, to drill, to pipe, and to bring online. By the time the oil finally flows, the world that ordered it may be long gone. The industry is permanently driving by a rearview mirror. So the loop goes like this. High prices today make everyone invest at once, because at $100 a barrel, every project on Earth looks brilliant. But the wall of new supply doesn't arrive until years later, all at the same time, by which point it's far too much. Glut. The price crashes. Terrified and now losing money, the industry slams its spending shut, and years later, demand quietly catches up to a supply that nobody bothered to build. Shortage. Prices soar, and the whole thing begins again. From the top. Economists have a name for this trap, where decisions and their consequences are separated by a long delay. They call it a cobweb. The delay is the cycle. The overshoot isn't a mistake anyone is making. It's built into how long it takes to get oil out of the ground. You just watched it happen in real time. The crash of 2014 frightened oil companies into cutting their investment budgets roughly in half, and they kept them low for years. That underinvestment was invisible until 2022, when a recovering world reached for oil that no one had spent the money to produce. Supply couldn't catch up, and the price ran back over $100. The barrels we don't drill today are the shortage we pay for at the end of the decade. That 5 to 10 year delay turns every sensible decision into next decade's mistake, and now the rhythm becomes visible. Run the whole 160-year record through the same mathematics used to find cycles in nature, a search for the dominant wavelength hidden in the noise, and one number stands out above all others: a supercycle lasting roughly 30 years. And it isn't just a statistical abstraction. Look at the great peaks of the real oil price, and the spacing is almost eerie. A high around 1948, the giant of 1980, and the record plateau of 2012. 32 years apart. 32 years. And again 32 years. Economists who study commodities have found the same thing across copper and coal and grain. Long supercycles, 2 to 3 decades from crest to crest, driven by the slow, heavy machinery of building new supply. Nested inside that long swing is a shorter one, a boom and bust roughly every 8 to 10 years, the fingerprint of that drilling delay, repeating across the decades. 2 clocks, ticking at once, inside what looks like pure noise. But here is where honesty matters more than a neat story. This is a rhythm, not a timetable. You cannot set your watch by it. Every single peak had a trigger no equation could have predicted. A civil war, an embargo, a revolution, a pandemic. The cycle is a tendency to overshoot, built into the physics of the industry, not a prophecy. And the next 30 years may not rhyme with the last at all, because for the first time, the world is trying to burn less oil, not more. The pendulum that has swung for a century and a half may be running out of swing. Whether it keeps its rhythm or finally goes still is a story none of us has read yet. If you found the hidden order in this chaos worth your time, stay and follow the line with us. Subscribe, and we'll keep pulling the camera back on the numbers that run your world. To continue to follow the line, like and subscribe.